Network.
Hello there, welcome to this edition of Global Business Africa. Last day of the year, we're going to run through all the business news stories you need to know about today and of course leading you into 2019 in the next hour or so. Before that though, we'll run through the markets, last trading day of the year here for you. So it basically closed all in the green for the most part, but keep in mind, even at these levels, none of these markets is closing in positive territory on a year-to-date basis. The worst performer of the lot is right here, the NSE 20. That is down 23% so far in the year. Will 2019 be any better? You're now going to find out. It's going to be an interesting ride. Here's what's coming up tonight. 2/3 of Tanzania's forex bureau to be locked out of business for non-compliance with new local laws. South Africa survives a festive season without serious power blackouts. And is Nigeria's budget at risk as global oil prices fall? We'll get some answers for you on those questions and plenty more in the course of the hour. Let's start tonight in Tanzania, where only about a third of the local forex bureau there have complied with a new law on forex businesses in the country that requires them to register afresh. Roughly 109 out of 297 forex bureau which existed before the start of this new registration requirements were passed have complied with the requirements of that law. The Finance and the Planning Minister, Philip Mpango, said that 188 entities did not meet the new thresholds and now they will be deregistered unless they meet them. He named one of the conditions that that disqualified some of these bureaus as their inability to meet minimum dollar capital requirements of at least $130,000 to be placed in grade A and about $435,000 in order to be in grade B. Now, when the South African President Cyril Ramaphosa announced a task force to have oversight on the Eskom board and management in late December, the utility at the time was in dire straits. Load shedding was a daily occurrence at the time. Here's CGTN's Angela Coppola with an update.
Load shedding has mostly been avoided since the middle of December, mainly because most businesses closed for the Christmas holidays and demand on the system has dropped significantly. The company also recently retrenched several senior executives. Others took a different approach.
Many of them have bite the bullet, and that's why they are willing to take a downgrade of their positions to a general manager level instead of executive level.
The task team has been monitoring management actions and will report back to President Ramaphosa at the end of January. This while the board and management attempt to develop a turnaround strategy.
Quite frankly, from our end, we don't have a view necessarily because the shareholder has every right to do what they have to do in terms of helping this company.
The problems at Eskom seem to be unresolved, and it's very likely that when people return back to work in the middle of January, there are going to be rolling blackouts. And this isn't good news for potential local and foreign investors.
But the investors want certainty, and one of the certainties, despite the political issues, they want certainty around small things like a security of power supply, and currently this company cannot give that.
I'm Angelo Coppola for CGTN in Johannesburg, South Africa.
All right then, from South Africa, let's zoom out into the wider region. Sub-Saharan Africa's recovery will progress, but rather slowly into 2019. And that's despite a historic free trade agreement being signed earlier in March. As CGTN's Alexandre Majala now reports, there is a glimmer of
to a continental free trade agreement in Rwanda. Though it encompasses 1.2 billion people, critics say it's done little to help the economy or lift its people out of poverty.
If the African Continental Free Trade Area is to work, it's important that we see more manufacturing and agro-processing and processing generally in the continent. Otherwise, there's very little production to trade, with our neighboring countries.
The World Bank dropped its growth forecast for the continent from 3.1 to 2.7%. These new figures were attributed to difficulties faced by the two economies that usually prop up the continent. Weak household consumption growth and a contraction in agriculture hit South Africa, while Nigeria was struck by lower oil production, which offset the extra benefits of higher oil prices. Alarm bells also sounded over the rate at which some countries are taking on debt. The IMF reported that liability inflows rose from 3 billion in 2000 to 60 billion in 2017.
What we've seen is a pronounced increase in debt in the last couple of years. And there, of course, it reflects the big hit to their economies following the commodity price crash.
As well as taking on high levels of debt, other countries like Kenya, Somalia and Zimbabwe have hiked taxes, which they say is to carry out development goals. Still, the IMF does have a message of hope this Christmas. It predicts that most other African countries will have a brighter future and say they could grow by about 3.8% in the next year. Alexandria Majala for CGTN.
All right, then I'll run through some company news now for you. Revelers, likely you're being warned to budget and plan ahead for surge pricing by e-hailing services on New Year's Eve. Both Uber and Taxify implement what's euphemistically referred to as dynamic pricing. When demand increases to encourage drivers to get on the roads, basically prices go up. Uber Sub-Saharan Africa says that the service's pricing algorithms are determined by demand and supply, and on New Year's Eve, demand does soar. In Kenya, Telkom Kenya is pushing for the implementation of agent and merchant interoperability to ease the process of cross-network transfers. Now, if implemented, that agent and merchant interoperability would essentially mean that customers, for example, on T-Cash, its mobile money offering, would be able to withdraw funds from Safaricom's M-Pesa or Airtel Money agents and vice versa. Zambia's 2018 copper production is forecast to rise above the 800,000 tons produced last year. Copper output in 2018 continued to increase with a total of 696,526 tons produced between January and October. Compare that to just under 655,000 tons in the same period in 2017. Now, the fairly high global copper prices average about $6,600 or so dollars a ton, and demand provided the impetus for more copper output. It's time for a short break on the program. Here's what's coming up next. Nigeria's budget implementation risks shortfalls as global oil prices decline. And Tunisia marks a slow economic recovery in 2018 after years of turmoil.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business. Only on CGTN.
Every story starts out like this.
Okay. We'll head up now.
But beyond the rush of the numbers, there's always a more fundamental question. What happened? Who has been affected? When market-moving decisions are made, who's responsible? And why?
Let's get some reaction on ground. Joining us in Johannesburg is Sutra Naidoo. Hello, Naro.
This is how all stories begin. See how they end. Only on Global Business.
How will your world change today? What happens here? What happens there? Or what you make happen for yourself? If it matters to you, it matters to us too. Your stories are the stories that need to be told. Africa Live. Find your voice.
Welcome back to the program. Let's head over to North Africa, where according to analysts, 2018 has been a pretty difficult year for Tunisia. A recent study shows that about 67% of the country's citizens sees the country's future as bleak and uncertain. Others reckon the state is on the right track. CGTN's Adam Chouachi sums things up from Tunis.
According to the Tunisian Forum for Social and Economic Rights, FTDES, 2018 was a difficult year in the North African state. In January, 773 people were arrested in 11 cities for damaging public property when violent clashes erupted during nighttime social protests. In addition, at least 10 Tunisian and Algerian terrorists were killed in anti-terror campaigns. Several security forces and civilians also died in multiple terror attacks.
The cabinet reshuffle did not ease social tension. Protests continued until the last week of December. The state has made significant progress in the war on terror, but the security situation is still fragile.
2018 was also marked by a migrant shipwreck in Kirkena. 87 people lost their lives, including 20 migrants from Sub-Saharan Africa. Some 3,000 irregular migrants arrived in Italy by sea in the past 12 months.
Tunisian and African youth are desperate. They are fleeing poverty to what they believe to be better life in Europe. African states and the EU can work closely to provide job opportunities in Africa, though the wave of migration will not stop in the Mediterranean.
Economists acknowledge that Tunisia is facing an unprecedented economic crisis. However, the national economy has shown some signs of recovery in the last quarter of 2018.
Economic growth has reached 2.6%. The average was about 1.5% in previous years. This is due to better performance of agriculture, tourism and services. The main challenge is the state's budget balance. Reducing the public sector wage bill is necessary. It grew from 10.7% of GDP in 2010 to more than 15% in 2018.
When the government and the labor union failed to reach an agreement on salary increases in November, more than 1 million high school students did not sit for exams, when about 73,000 teachers went on strike nationwide.
According to analysts, 2018 was also marked by political turmoil due to the conflict between the premier and his ruling party. The country's president has called on all parties and organizations to sit to the negotiating table. Beji Qaid al-Sibsi insisted on working together on improving the social, economic, political and security climate. Aden Shawashi, CGTN, Tunis.
All right then, let's focus on West Africa, specifically Nigeria. Of course, it's home to Africa's largest economy, but the continuing meltdown in global oil prices is threatening its budget implementation, especially for 2019. You see, the price of crude oil has dropped around $50 a barrel. That's $10 below the country's $60 per barrel 2019 budget benchmark. The prices of Brent crude, WTI and OPEC grades have also fallen to around $50, $45 and $53.92 a barrel respectively. Now, traders attribute the developments to oversupply coming in from non-OPEC oil producers. We'll cover that a little later in the hour, which are not involved in the supply cut deal that was arrived at earlier in December. In the meantime, OPEC says it is committed to achieving stability in the market. Will that stability be achieved? Let's find out. Deji Badmus joins us now live from Lagos with more data on this story. So, Deji, let's start with the budget. As things currently stand, when is this budget going to be debated by both houses of Congress?
Honestly, Rama, no date has been fixed yet, and it's difficult to see these lawmakers now debate the budget anytime before the election. We're in the heat of the general election campaign in the country. All the lawmakers are busy campaigning at the moment, so it's really difficult to see how this budget would be debated and passed before that election, especially when you consider the processes involved. It has to go through the committee stage, it has to go through different stages before it is now debated at plenary and then passed. So there's every likelihood that the budget might be delayed until after the general election. So I just don't think it might happen. But I wish it could happen, you know. I just wish it could happen, but it's difficult to see that happen.
Indeed. Of course, I should point out for the benefit of our viewers that those elections that we're talking about will be happening in February. But let's focus on the assumption. I know you and I are on both complete opposite ends of this argument, but the assumptions on oil production volumes and oil prices were way off for the 2018 budget. So, assuming that legislators even debate this thing on time, what reason would the budget committees have to actually retain those assumptions that have come out of Aso Rock?
First of all, what I think they're going to do is they might retain the production level at 2.3 million barrels per day, because at the moment what we're told is that we're doing around 1.95 million barrels per day. That is what the president said when he presented the budget to the lawmakers earlier this month. Other than that, I think the benchmark oil price will definitely be brought down. Now, let me just tell you why I think the lawmakers may retain the 2.3 million barrels per day. It's just because, remember, the Egina platform will start pumping oil. As a matter of fact, we understand by February, in fact, that it will start pumping oil. So, and we expect that from the Egina oil field, Nigeria would be able to pump out around 200,000 barrels per day. Now, if you add that to 1.95, then there's every likelihood that we might be hitting 2.3 million barrels. But then, when you take into consideration, because we still do not know what our OPEC quota now would be, I mean, I'm talking about the production cuts now, we do not know what it will be. But if you take into account that 200,000 barrels that will be coming from the Egina oil field, then there's every possibility that Nigeria will be able to make 2.3 million. But in terms of the oil benchmark price, I think it will definitely come down. As you've reported, oil is trading around $54 per barrel. There's every likelihood that it might go down below that figure. So we might be looking at a situation where the lawmakers may decide to come down to, say, a level of maybe between $45 and $48 per barrel.
Indeed, and of course, just to update our viewers on that, 53.44 is a relevant number for Brent crude at the moment, and the US is right now the world's biggest oil producer. New record being set for October, more than 11.5 million barrels of crude a day coming out of the US, according to data on the Bloomberg terminal. But let's dig into the revenue side, right, of the 2018 budget as well. So income tax revenue for the government up 23%, VAT more or less flat, about 5% higher, import taxes up 11% year on year. But does the Budget Office expect similar performance in 2019, given the fact that 2018 growth was relatively low and 2019 seems to be just as flat?
Well, 2019, the expectation is that, according to the government, looking at the budget, the government projects a 3% growth rate, and you look at what the World Bank has projected, somewhere in the region of 2%. Now, what I think, and in this case, I think, you know, the government would have no choice. The government would have to do better than the 2018 revenue figures, especially when you consider the fact that what we will be expecting, the revenue from oil will be lower than projected, than budgeted, when you consider the price of oil and then you consider that OPEC cap. So there's every likelihood that what is budgeted, what is provided for in the budget in terms of revenue from oil, we might not be able to meet that. So we just have to look at these non-oil sources now to get revenue. So I expect that the government will try to do better, drive up revenue from these non-oil sources now, like you know, companies' income tax. You talk about import duties and what have you. The government would have no choice than to try to do better with VAT, for instance, because if the government doesn't do that, it faces a very tough challenge. Because to be candid, Rama, you don't need a prophet to know that what we're going to get from oil would be far lower than what is budgeted. So in this case, everybody, all the government agencies will just have to do much better than they did last year. I'm talking about the revenue generating agencies of government now. They would have to do better than they did last year, or else the budget, as some people would say, might just be dead on arrival.
Indeed, that $25 billion spending plan isn't going to be funded by air. One last question for you, Deji. The budget minister pointing out that the state needs to finish the restructuring of joint venture oil assets in 2019. That should have happened this year, but it didn't. What does this process involve, and what is the outcome here, both for the government's stake in these oil production outputs, in these oil production facilities, and of course for Nigerian citizens at the end of the day?
Well, basically what the government is trying to do by restructuring the joint venture is basically to sell off its stake. The government wants to cut down now on its stake, sell down its stake now in this joint venture. What we have heard, what was said, for instance, what the Minister of State for Petroleum said sometime last year was that the government was looking at cutting down its stake from around 57% to somewhere around 40%. So we're looking at a situation where the government will be selling off 10% of its stake, and the expectation is that that would raise, in terms of revenue now for the government, around $2.3 billion. Now, we do not know, because that process is still on, and we do not know when it will be finalized, but I expect that it will be finalized in the new year, because the government needs the money. And then the government is doing it not just to generate revenue, to make money. The government is also doing it, to make the oil industry more efficient, because, for a long time now, the government has always been challenged in terms of meeting its own side of this joint venture agreements, especially when it comes to, what is called the cash call now. The government has not been able to meet its own side of the bargain. And then the government wants to bring in private sector participation into the oil industry. And that way, it'll be able to guarantee efficiency and then make more money. So the expectation is that it would sell off part of its stake and then make money from that, get more people, private sector participation now, and then get the oil industry to run efficiently. So basically, if that happens, you would see that government's assets now in these joint venture projects will definitely come down. As I've said earlier, they say they're looking at cutting it down from 57% to somewhere around 40%.
Indeed. Of course, the question at the end of the day does remain, who will buy those stakes without the Petroleum Industry Bill having been passed? We'll cover that a little later. That's Dejiban was there live in Lagos. Let's turn our attention now to East Africa. 2018 is the year when the world watched as a new Ethiopia emerged from troubled times. It saw decades of famine and conflict now replaced with widespread political and social and economic reforms. Now, both economic and political analysts agree that continued stability on the political front is vital if the country's growth is to continue. Here's my colleague now, Ocho Koronko, examining Ethiopia's wins in 2018 and what 2019 may hold.
Perhaps the biggest surprise of 2018 came in Ethiopia. Some economists are calling it the Abiy effect. Back in March, the appointment of new Prime Minister Abiy Ahmed pretty much upended the country's previous political, diplomatic and business systems following a lifting of a state of emergency. Abiy's move to defuse a conflict that has plagued the Horn of Africa for decades revived the possibility of an integrated Afro-Gulf region. Already, we've seen the practical implications of a peace deal with Eritrea. Ethiopian Airlines began daily flights between Asmara and Addis Ababa. Landlocked Ethiopia now has access to Eritrea's Red Sea ports. And Eritrean industries can now service the growing markets of its much larger and more populous southern neighbor. The peace deal will eventually benefit the wider sub-region. But of course, analysts point out that negotiations are still in their early stages, and the process is likely to take time. Abiy has also made a move to tweak Ethiopia's economic model, with a strategy that seems to evolve around state-backed development and an open and vibrant private sector. 2018 saw huge investments in infrastructure, specifically its standout project, the Grand Renaissance Dam. It will be the largest on the African continent and will house 2 power stations with a combined output of 15,000 gigawatt hours per year. The government also plans to offload shares in some of its major state enterprises, such as Ethio Telecom, Ethiopian Airlines, and electric and logistics firms. Abiy is also encouraging more foreign investment in its manufacturing industry, mainly into new industrial parks and privatization inflows.
Currently, 15 industrial parks are in the pipeline, most of which were built and will be operated by Chinese companies. All this is why some economists are calling Ethiopia the new China. With cheap labor costs, it is angling to compete with India and China. Already, fashion brands like H&M, Guess, J.Crew and Naturalizer have established manufacturing centers in the country. And that is why it is now Africa's fastest growing economy. Growth is expected to step up in 2019, supported by stronger confidence as past uncertainties slowly disappear. But the IMF says there are risks to its outlook. Large external imbalances and the high risk of debt distress are some of the key threats that could constrain any future growth. Those can be managed by better fiscal responsibility. But in order to reshape its dynamics in the next decade, Abe has to deliver on his promise for more inclusive political dialogue, as well as the opening up of its economy to private investment and competition. Uche Okoronkwo, CGTN.
Energy is one of the more promising and interesting sectors that we've covered all year in Egypt. It's a bit of a burden, though, on the state budget, in part because of the cost of importing and maintaining fuel subsidies, as well as electricity generation. Now, the Egyptian government has worked relatively hard this year to improve the production output in this sector. Here's Yasser Hakim with the details.
The energy sector has been the most successful in Egypt's economy in 2018. The main boost has come from the natural gas discoveries that have transformed Egypt from importing about $2.5 billion of LNG a year to become self-sufficient in natural gas.
Our production reached 6 billion cubic feet. That was the maximum, and we reached 3.6 in mid of 2016, which put us from an exporting to importing country. So that was a lot of pressure on the economy. But with the recent discoveries, now Zohr gas production is about 2 billion cubic feet. We turn back again in a few months ago back to be self-sufficient when it comes to gas. Oil, we still import 30% of our consumption of oils.
In 2018, the government continued its 5-year plan to gradually cut subsidies on fuel and electricity to reduce expenditure and balance its budget deficit. The revenue has also been used to pay off the $6 billion debt owed to the foreign oil companies. And this has paved the way for more investments in oil exploration in the Red Sea and Mediterranean.
We have a lot of new technology going to be implemented to basically increase the production in the Gulf of Suez. We can't forget the Red Sea, and Egypt is doing seismic now for the Red Sea, and now we will be able to open new concession for exploration for the Red Sea. Gulf of Suez with the oil, Mediterranean, I think Zohr is a good start. I think the East Mediterranean, or what they call the Nile Delta Basin, which covers North Egypt.
More oil and gas discoveries will also provide enough energy needed for the growing number of industries and foreign investments being poured into the country.
Experts say 2019 could see further expansion and more revenue from the energy sector, as Egypt is expected to become a major exporter of natural gas in the region. Yas Hakim for CGTN, Cairo.
China continues to forge bilateral ties with a growing number of economies here in Africa. 2018 saw some interesting investment opportunities across a range of sectors, including infrastructure and energy. Here's CGTN's Penina Kariba now looking at some of the deals made in Kenya, South Africa and Ethiopia.
This year saw China and African cooperation on different sectors across the continent. In the agricultural sector, China signed accords with Kenya that will allow access for farm produce from the East African nation. The deals took place during the China Export Expo, the first of its kind held in Shanghai. Kenya can now ship its biggest farm produce, flowers, vegetables such as green beans and fruits, including avocado and mangoes, to China. China is Kenya's biggest trading partner, with exports amounting to $167 million last year, while imports were $3.78 billion. In Ethiopia, China agreed to restructure some of the country's debt. This included a $4 billion loan for a railway that stretches from Addis Ababa to Djibouti. The landlocked and the Red Sea state inaugurated the railway in January, with 70% of the total cost covered through a loan from the Export-Import Bank of China. The repayment of the railway debt was extended from the original schedule of 10 years to 30 years. The deal was made amid rising concerns over debt distress, with the Ethiopian government's debt reaching 59% of the country's annual gross domestic product. In South Africa, China Development Bank signed a term facility agreement with the troubled state-owned power utility Eskom worth $2.5 million. The deal took place during the 10th BRICS Summit, where 5 of the biggest emerging economies, Brazil, Russia, India, China and South Africa, gathered in Johannesburg. Eskom Chief Executive Phakamani Hadebe said the agreement was strategic for the power utility, both for investment and capital growth. China also agreed to invest around $1 billion in the country's various sectors. These include infrastructure, ocean economy, green economy, science and technology, agriculture, environment, as well as finance.
At the same time, we must work together at the United Nations, the G20 and the World Trade Organizations to safeguard the rule-based multilateral trading regime, promote trade and investment liberalization and facilitation, as well as rejecting protectionism outright.
Our task is to give practical expression to an economic partnership that will catapult the industrialization of our respective economies beyond digital age. While trade amongst BRICS partners has expanded exponentially over the last 10 years, we need to advance to a new level of industrial cooperation.
During the Forum on China-Africa Cooperation Summit held in Beijing this year, a declaration and action plan were adopted between the two sides. In the declaration, China pledged to act in the principles of sincerity, real results, affinity, uphold justice, while pursuing shared interests and focus on supporting Africa's capacity building for internally driven development. The vigorous development of China-Africa cooperation has not only promoted the progress of Africa, but also inspired international partners to pay close attention to Africa. African leaders who attended this summit spoke highly of the summit and agreed that it was a historic meeting, strengthening Africa-China solidarity and cooperation.
Under the framework of the 10 major cooperation plans, China will work closely with African countries and implement 8 major initiatives in the next 3 years and beyond. In fields like industrial acceleration, infrastructure connectivity, trade facilitation, green development, capacity building, healthcare, people-to-people exchanges, and peace and security.
With more ties and exchange established between Africa and China this year, it is hoped that the two sides will continue to further relations in the years to come. Penina Karibe, CGTN.
All right then, time for another break here on the programme. Here's what's coming up next. A trade war notwithstanding, President Xi and Trump praise 40 years of diplomatic ties between China and the United States. And the 11-country Trans-Pacific Partnership Free Trade Agreement comes into effect.
Business in Africa is at a crossroads. We celebrate those who are adopting and thriving despite the challenges, from grassroots to big businesses. Global Business takes you along for the ride as we track the making of a giant.
Only on CGTN.
Welcome back. These are the stories making your headlines at this hour. Some parts of the planet are already in 2019. In countries like China, Australia and New Zealand, revelers over there bid 2018 goodbye and have ushered in the new year with a lot of parties. More than 1 million people lined the world-famous Sydney Harbour to watch the biggest fireworks display the city has ever seen. On to other matters, in the Democratic Republic of Congo, the opposition said on Monday that it expected one of its candidates to win the presidential election based on early vote tallies. But the ruling party coalition said that it was confident its candidate had won the poll. Now, the electoral body says it will announce the final results from this long-delayed election on the 15th of January. And Sudanese President Omar Hassan al-Bashir has called on security forces in the country to exercise restraint with protesters. This comes as the UN called for a probe into the violent protests which have left at least 19 people dead. The protests over there were triggered by fuel shortages and a spike, a pretty severe one, in food prices. That's a run through your headlines. All right then, the Chinese President Xi Jinping and the US President Donald Trump on Tuesday exchanged congratulations on the 40th anniversary of the establishment of China-US diplomatic ties. In his congratulatory message, Xi said that China-US relations have experienced ups and downs and have made historic progress in the last 40 years, bringing significant benefits to the two countries and contributing quite a bit to world peace, stability and prosperity. President Xi has said that history has proven that cooperation is the best choice for both sides. For his part, Mr. Trump said it is his priority to promote cooperative and constructive Sino-American relations, adding that his friendship with President Xi has laid a firm foundation for the achievements of the two countries in the years to come. All right, so let's get a little more detail on this from CGTN's Jim Spellman, who joins us now live from Washington, D.C. So, Jim, the trade dispute not directly referred to in the New Year's speech, but what did policymakers in Washington make of the comments from President Xi Jinping?
Happy New Year to you. No official comment yet from the White House on the speech, but no doubt policymakers here in Washington were listening closely, especially as this trade negotiation continues. President Xi certainly didn't give anything away in the speech, but I think this passage is something that U.S. officials will be happy about. She said this, quote, "The world has seen China's accelerating reform and opening up and its determination to carry it forward. China's reforms will never stop and its doors will only open ever wider." With the recent positive developments in the ongoing trade negotiations, I think many in Washington will take that as a positive sign.
Indeed, but let's focus on the specifics here because teams from both sides are set to meet sometime next week to iron out the key disputes in this ginormous trade row. What does a US team want to get from those talks?
Well, first, the U.S. side wants to close the trade gap between the two countries and also wants to see China abandon industrial policies that are meant to boost that country's high-tech sector. Closing the trade gap to some degree could be accomplished by China buying more U.S. products like soybeans, airplanes, liquefied natural gas, and we've already seen a resumption of soybean purchases, which has been welcomed here in Washington. Now, getting China to scale back measures to promote its own high-tech sector has always been a tough sell at very best, and in his speech, President Xi emphasized Chinese innovation and self-reliance. So, while it's not likely we'll see China pull back from promoting its own economy, we have already seen a willingness to further open the Chinese market to overseas businesses. The question now, will that be enough to satisfy President Trump? On Saturday, as you mentioned, the two presidents spoke and Trump tweeted about it, saying that he had just had a long and good call with President Xi of China, says the deal is moving along very well. If made, it will be comprehensive, covering all subjects, areas, and points of dispute, and he said that big progress was being made. So while there is reason to be optimistic, we have to keep in mind that we have seen this U.S. president change course before.
Indeed. So let's look at what happens if that is the case. Is there any indication at this point that the White House might be willing to impose tariffs or perhaps use rules of origin rules in order to widen this trade row with China to other countries that do host Chinese firms, assuming there's no agreement, no trade deal after this current 90-day truce?
I think we have to assume that that is absolutely possible. Trump has said if a deal can't be made, he'll raise some of the existing tariffs from 10% to 25% and has even threatened to place tariffs on all remaining Chinese imports. He's followed through with tariffs in the past. There's no reason to believe that he wouldn't do it again if he doesn't get a deal he likes. But Keep in mind, stock markets are on much shakier ground than when Trump began this trade conflict, and the U.S. House of Representatives will soon be controlled by Democrats, meaning the U.S. president will have a harder time pushing his agenda through in the new year. That alone could be enough to change President Trump's approach to these negotiations and make him more willing to accept a deal.
Indeed. Jim Spellman there, Washington, D.C. Thank you very much. Now, 2018, what a year that has been. Let's focus on that very topic from our conversation with Jim Spellman. We talk about, of course, China-US trade tensions, stock market turbulence, commodity volatility, and a tightening monetary cycle. 2019 will be packed with fresh market jitters over pretty much the exact same things. And China is smack in the middle of all those just mentioned stories. So how should investors stay ahead of the curve? CGTN's Xie Cheng gives us a recap of 2018 and a preview of the next.
It was a roller coaster ride in 2018 thanks to the China-US trade war being a major surprise, a seesaw spat over Brexit deal, and global central banks tightening bias. But don't unbuckle just yet, as we have the same road bumps ahead after 2019's first 90 days of China-US trade truce.
To me, what the U.S. really wants is to decouple its tech sector from China's tech sector in order to maintain its technology dominance.
Before the US and China reach a final deal, safer assets will be high in demand.
For the domestic investors should still continue to overweight on the bond market, as we still expect the PBOC and the Chinese monetary authorities to introduce more monetary easing. So for the overseas market, we still like those kind of defensive stocks with the strong balance sheet.
The ECB has lowered its growth forecast while other European banks are staying put. US rate hike is likely to slow down while China's monetary policy will be accommodative. So where exactly are we in terms of monetary cycle?
Previously, we expect Fed to raise rates by 3 times, but now we only think it could at most do 2. The trade war would really hit the U.S. harder than it will hit China.
We see there's a lot of downward pressure on the Eurozone at this moment. So at this moment, we don't see there's a chance for ECB to raise the interest rate at the next 9 months of next year. So that will add some downward pressures on the euro currency.
As China wrapped up 40 years of reform and opening up, analysts expect more packages of physical stimulus ahead to target smaller players in the private sector and lower investment barriers for international investors.
In 2019, the risk is that the politicians, the foreign politicians, economists, fail to recognize the systematic importance of Chinese economy and also its impact on the global economy.
Xia Cheng, CGTN.
Now, the trade story wasn't just about countries locking each other out of their own market. The 11-country Trans-Pacific Partnership Free Trade Agreement has just about come into force now. Now, it's a fairly ambitious trans-regional pact. It was resurrected after Washington pulled out last year. The remaining countries, though, managed to reach a new set of agreements that lower tariffs and unify business rules, and they're now putting it into effect. Tariffs on agricultural produce and industrial goods will go down drastically under these renegotiated terms. Candidates applying for admission include Thailand and the UK. Exporters in most of the Asia-Pacific region are expected to win from reduced tariffs and access to entirely new markets as well. Now, the impact of the trade deal was significantly reduced when the US pulled out in 2017. But remember, by the numbers, it's still impressive. It covers nearly 500 million people, 13% of the world's GDP. Here's Owen Poland with more.
It seems quite remarkable that negotiations for what would become the Trans-Pacific Partnership first began 17 years ago. It was going to be the world's largest ever trade deal when the 12 member nations signed the initial agreement here in New Zealand in early 2016. However, the election of Donald Trump as US President later that year changed all that. He said it was a terrible deal and the US pulled out. The fact that the TPP has been rebooted by the remaining 11 nations represents a political and diplomatic victory for Japan, which has fought hard to establish this new trading bloc without the United States. However, the fact is the potential benefits have been significantly reduced because the US represented 60% of the combined GDP. In New Zealand's case, the economic benefits have been reduced to less than 1%. But that still means more jobs and export opportunities. The biggest benefit to the New Zealand is the establishment for the first time of 4 free trade agreements with Japan, Canada, Mexico and Peru. And of course, getting preferential access to Japan is a big deal. Japan is New Zealand's biggest kiwi fruit market, and as of now, tariffs have been completely eliminated on the fruit. Japanese tariffs on imported beef, meanwhile, have also been slashed by 10%. So that's a big boost for farmers throughout the region. Over the next few years, tariffs will eventually be eliminated on most major commodities amongst the member nations. And the irony of all this is that the TPP was originally designed to give the US increased access to Asia. But right now, US farmers are missing out. Owen Poland, CGTN, Auckland.
Now, from American sanctions on Iran to concerns about oversupply, 2018 did see some major changes in the global oil markets. But what impact do they have on you and I? Here's CGTN's Rosanna Lockwood with his report.
The year began with Iranian oil being widely traded, but it's ending with Tehran's energy exports feeling the heat from US sanctions. Uncertainty dominated the markets ahead of those restrictions being enforced in November, but it hasn't drawn the type of price spike many analysts predicted. Instead, oversupply now appears to be the word of the day. The game changer for global markets in 2018 may well have been US production.
We've seen how U.S. crude exports 2 years ago was 500,000 barrels a day, then 1 million, 1.5 million, 2 million. The latest weekly numbers were over 3 million. Now, I don't know if that's sustainable yet, but it really has an effect on global markets.
Meanwhile, the Intergovernmental Oil Organization OPEC has been forced to react to a changing landscape.
A Gulf rift has left its mark on 2018. The ongoing spat involving Saudi Arabia and its regional allies such as the UAE pitted against Qatar has spilt over into OPEC unity, with Doha recently making the decision to leave the organisation in 2019.
Given Qatar is an LNG powerhouse, analysts doubt this will massively impact on OPEC's goals. But major changes do appear to be afoot, with the recent agreement to cut production highlighting a shifting dynamic.
Well, I think the Saudi-Russia axis has become extremely important in terms of managing supply. Yes, Russia has been, which it's never really been before, an active player in collaborating on supply decisions and in cutting supply. Not cutting as much as the main OPEC countries, but still cutting. And that was really crucial, of course, in making sure that OPEC could actually deliver these cuts. And there are a lot of members, including Saudi Arabia, who didn't even want to come into cuts unless they could be sure that they wouldn't be losing market share to Russia and some of the other non-OPEC countries.
Another supply factor set to seep into next year concerns waivers granted by Washington to some importers of Iranian crude. On paper, they're supposed to be temporary, with the US looking to further restrict Iran's energy output. Add to the equation slowing global economic growth and an unresolved trade spat between China and the US. Some of the headwinds moving commodities markets this year look set to make their mark on 2019 as well. Rosanna Lockwood, CGTN, Dubai.
All right, then before we jump into the next break, a quick run through the commodity prices for you. So 2018 has been a pretty rough year for commodities, generally speaking. Crude oil, for instance, it's down about 18% so far in the year. The Bloomberg Commodities Index, which tracks a lot more different commodities, that's down about 12% or so. Copper hasn't done particularly well either. That's down over 15%. And a key thing to watch out for is the manufacturing data that we've seen coming through from China. The PMI falling into contraction territory with a reading of about 49 or so. That doesn't bode well for commodity exporters like Zambia as well. Those are your commodities. We'll keep a close eye on these numbers. Here's what's coming up next. Cairo hosts the second edition of the Food Africa exhibition.
Images may appear to be identical, but looks can be deceiving. The difference is not always obvious. It has to be discovered. There are always different sides to a story. We put the focus on the details. To see more, to understand better. CGTN. See the difference.
The greatest journeys
The greatest sights, the greatest adventures.
Here in Qanater, this weir allows the locals to walk on water.
We're far more than just TV news. We're your passport to the wonders of Africa.
To bring you stories of struggle, survival and hope.
So let's explore. CGTN. See the difference.
Welcome back to the program. The Egyptian capital, Cairo, has hosted the second edition of the Cairo Food Africa exhibition. Now, the event aims to create opportunities for agricultural producers to market their products and increase trade, especially among African economies. CGTN's Yasser Hakim was there. He filed this report.
Over 300 companies from around 30 countries gathered in Cairo to showcase their products at the Food Africa Fair.
Trade fair is a huge opportunity, not only for Egypt but for the African countries to work together on intra-trade among Africa, and also facilitation of trade with the world. It's an opportunity for all the sectors, also for countries and nations, and to present their potentials.
The products on display range from food to equipment and machinery for agricultural industries. Producers hope exhibitions such as this one would help increase their sales and marketing targets.
Our products have a good presence in the local market for some time now, and we are doing fine. We are here because our plans are to expand to the rest of the continent, enter new markets in Africa and Arab countries, and this is a good venue for doing so.
The fair also attracted many companies from outside the continent.
We have lots of traction from several countries, not only from Africa. We have visitors from Ukraine, visitors from Kenya, visitors from Brazil, visitors from Malaysia. The exhibition actually gives us the opportunity to network with people from actually suppliers. We can meet